Good day, Junior Techies. I'm Mrs. Brimacombe. We're going to look now at Chapter 11, Financial Statements, Analysis and Interpretation, Activity 4. Question 4.1, GOB Principles. Choose the correct word to match the example. Write only the correct word or words next to the question number 4.1.1 to 4.1.6 in the answer book. So if we're looking at the first one, interest on overdraft is shown as a separate amount to bank charges in the statement of comprehensive income. The GOB principle being applied here is materiality. Important information must be shown separately. We need to know what is the cost of borrowing money. In this case, when we have a bank overdraft, it means that we're borrowing money from the bank. So we need to pay for that, and that is called interest on overdraft. 4.1.2. Trading stock is still shown at the cost price of $15,000, even though it would be sold for $12,000 at the flea market. This is the going concern. Will the business continue in the foreseeable future? You need to understand each one of these GOB principles and able to apply them. The third one, land and building is recorded in the statement of financial position at $700,800 for the past 12 years. It was recently appraised at $1.8 million. We need to apply historical cost. That's why we've shown it now for 12 years at what was the historical cost. What was the cost the day that we've purchased it? Yes, it is valued more than the cost at 1.8 million. But we need to be showing, but what was the original cost the day that we've purchased that? Otherwise, we could end up overstating our financial statements. Number 4, the owner bought a new vehicle for his daughter's 18th birthday. That is not a business expense. It's not for the business. It's not a business asset. It means that this must be shown as business entity principle because it's a private vehicle that was purchased. Number 5, the telephone account has not been paid for the last month of the financial period. This amount becomes expenses payable. What we need to do, we need to look at in this accounting period, which is 12 months, what was all our income and all our expenses. If it's still outstanding, it means it still forms part of my expense for this accounting period. And that's why we need to show it. But this is now not paid yet. It's still outstanding. So it goes to expenses payable. So we need to match that. We're adding it to our telephone expense account. Now we need to match that. And it means that we're going to take it to expenses payable. All income and expenses must be shown for 12 months. Number 6, a debtor paid $12,000 to settle his account. This payment will only reflect in the next accounting period. So if it's not reflecting yet, we cannot say, but he made a payment and the business is going to receive $12,000. We need to apply prudence, which means conservative. Until that money is reflecting, we're not going to show that we've received that money for this accounting period. I can also use bad debts as an example with regards to being conservative. Provision for bad debts, Provision for bad debts means we need to make provision that we're not going to get money in. We hope that we get all the money in from our debtors, but we are being conservative, and then we make provision that we're not going to collect some of that money. This is an introduction, it's an adjustment which you are going to learn in grade 11. 4.2, Statement of Financial Position and Notes, and also looking at analysis and interpretation. So 4.2.1 says, prepare the following notes to the Statement of Financial Position for the year ended 31 July 2023. The tangible asset, capital, trade and other payables. 4.2.2, Complete the statement of financial position for the year ended 31 July 2023. Show all workings. And then 4.2.3, the owner, Tracy, asks you to write a report on the following questions that she has with regard to the business. So this is talking about financial indicators, analyzing and interpreting. Now, if you look at the information, it's a list of balances on 31 July 2023. Take note that fixed deposit ABBA Bank has a question mark. There's a reason there's a question mark. Now, the same approach as we've done with the statement of comprehensive income. When we start, you're going to look through the adjustments. You're going to familiarize yourself with the information. But when you start, your step number 1 is to write everything from the list of balances and take it where it's supposed to go. Now remember, they've asked you to do the tangible asset, capital, trade and other payables, and then the statement of financial position. So all of these need to appear somewhere. But now you just need to be careful. Things like your assets. When we look at our tangible asset note, we look at balances in the beginning, movement, and the balances at the end. So you need to look at, this is a list of balances given at the end, but we need to see, was there any movement? The same as with capital. Was there any movement during the year? Has it been recorded or not yet been recorded? Because that will make a difference in where you're going to put these things. And then when you are done, then you close the brackets and you work out the final figures. So starting now with the tangible asset or fixed asset. The list of balances, land and buildings, vehicles, and accumulated depreciation on vehicles. Take note, they set on the 1st of August 2022. So you know for a fact that is in the beginning of the accounting period. But we don't know yet with vehicles and land and buildings if there were any movements. So we need to look at the additional information. Adjustment number 1 says, an invoice received on the 25th of July from Rebuild Construction revealed the following: repairs to offices, painting of offices, painting of the owner's residence, storage facility on the business premises. And what happened now? The bookkeeper erroneously debited the full amount to repairs and maintenance. It means that all of that was added to repairs, and it shouldn't have had, because some of it was repairs, some of it was additions to land and buildings, and some of it was a personal expense. The business entity principal, the owner's personal finances must be kept separate. The owner's home, his own residence, is not a business expense. That must go to drawings. So all of this was incorrectly debited, which means that we need to only look at but what forms part of my land and buildings. Repairs and maintenance, we need to take it out of that. But they haven't asked me to do the statement of comprehensive income. So what will happen? We need to take it out, which means our repairs will be credited so that land and buildings can be debited, so that drawings can be debited. And when land and buildings is debited, that is my additions at cost, 80,000. Now, this has not yet been recorded. Yes, it was recorded, but in the wrong place. It was not yet recorded as part of the land and buildings. That's why the balance from the pre-adjustment will be the balance in the beginning. And that means we now need to calculate the balance at the end. To take the balance at the end, we take the beginning plus the additions. Please remember, we do not calculate depreciation on land and buildings. That's why we're going to indicate accumulate depreciation at dash, disposal, not grade 10 level, depreciation. So it means that your cost is equal to the carrying value. Now, adjustment number 2. They provided you with a summary of the fixed asset register, and it revealed the following. Remember that a fixed asset register is an individual record of each one of our assets. So they told you this is all of our vehicles, our fixed asset register that we've got. When did we purchase it? What was the cost? What was the total accumulated depreciation? And what is the book value? Now, provide depreciation on vehicles 25% on cost. Note, the purchase of vehicle THY179GP, in other words, that vehicle, was bought and recorded in this accounting period. It says there, 1 November 2022. That is our current financial year. That's why we don't have any accumulated depreciation or any book value for it yet, because we haven't calculated depreciation on it yet. When we calculate depreciation on the new, it's from the day we purchase it until the end of the accounting period. On the old or remaining, it is always equal to 12 months. So if you look now at these totals, if I add all of those costs, it is the same as the figure which is given here. Because what is the purpose of this account? This is a summary of all of it added together. To calculate depreciation using the fixed installment method, because that's what on cost means, fixed installment or straight line, it means that we need to look at the cost, and I'm going to do each one individually. It's the reason why they give you information in the manner which I've done. If you take note there, you can see the date. This was purchased 1 August 2019, and we're already in 2023, the current financial year. So if you take your cost and you times that by 25%, it's 37,500. But now you always need to check, especially with the asset that is that old. If I add this now to the accumulated depreciation, what will that equal? And if you look at the depreciation, it equals the book value as well. Red light should go off. That will be a problem. Because your carrying value can never be zero. It can never be a negative amount. It means that your carrying value should then be 1. So to calculate your depreciation on that vehicle for this accounting period, we need to take 37,500 minus 1. That equals the depreciation. If you take 37,500, the depreciation, and you add it to accumulate, it will give you 150,000. Then the cost and accumulate is the same. Cannot be a zero, cannot be a negative amount, the book value. To go to the next asset, KGH14GP, the cost is 210,000. If we times 25%, it means my depreciation is 52,500. And that, if it's added to the accumulated depreciation, it will definitely not be the same as the cost. To calculate the depreciation on the new, the cost was 270,000 times 25% if our accounting period ends 31 July 2023, and this was purchased on the 1st of November, it means we need to calculate depreciation for 9 months from the day it's purchased until the end of the accounting period. To calculate the total depreciation, we need to add all of that together. That equals 24. So just what do you need to be careful of? If you had added those two together, to calculate the depreciation on the old, your answer would have been different. You need to make sure that you calculate it individually, and that's because that asset is actually going to become zero now. If we calculate the depreciation on it, it would have been zero, and it cannot be a zero. To calculate your vehicles, not to calculate, to complete the tangible asset note for vehicles, we start with the additions. The additions was 270,000. Now, because this has been recorded, it means that this cost at the end is the cost at the end, and we need to work out the balance in the beginning by taking 650,000 minus 270,000. Your accumulated depreciation, just take note of this. This is a fixed asset register. If I add that together, it equals the same as in the list of balances which is given, and that was the balance in the beginning. My total depreciation must be shown in brackets. To calculate the accumulate at the end, take the beginning plus the depreciation equals, it must be shown in brackets. Get the carrying value. To get the carrying value, cost minus accumulate equals. Then we need to look at our movement. And our movement is the 270,000, which is the additions, minus the depreciation equals, no brackets, it's a positive figure. Carrying value in the beginning plus the movement equals the carrying value at the end. If you take the cost minus the accumulate at the end, it should give you exactly the same answer. To get my total, I've got options now. We can just add each row, each line, or we can start with the cost by adding the land and buildings plus vehicles minus the depreciation equals the carrying value in the beginning. If I add those two together, it should give you the same answer. When we're looking now at our movement, our total additions minus the depreciation equals the movement. Carrying value in the beginning plus the movement equals carrying value at the end. You can check in to see if you've done this process correctly. If you add those two together, it should give you exactly the same figure. The cost at the end minus the accumulate should equal the carrying value at the end. If it does, it's correct. If it doesn't, somewhere you've made a mistake. Completing note number 7, which is capital in a sole trader. We always have, study this note, the balance in the beginning plus the net profit or minus the net loss plus contribution of capital during the year minus withdrawal of capital during the year minus withdrawings equals the balance at the end. They provide you with the capital and withdrawings. But now you need to look at the additional information first to see, was there any movement with regards to that, any adjustment with regards to that. So if you remember adjustment number 1, painting of the owner's residence, 15,000, that means that needs to go to the drawings, which means it must be added to that 405,000. Then it says the owner increased his capital by providing 500,000 cash on the 1st of July 2023. This has been recorded. So if this has been recorded, that 500,000, it means that the balance from the pre-adjustment trial balance or the list of balances will be 1.9 million minus 500,000 equals 1.4 million. That was the capital balance in the beginning. Then the last adjustment, after taking all of the adjustments above into account, the business made a net profit. That must be added. My drawings was 405,000 in the list of balances. This was not yet recorded. Again, it was recorded, let me rather start again with that. It was recorded, but in the wrong place. So it wasn't recorded as drawings. That's why that balance, 405,000, we need to adjust that. We need to add 15,000 to that. That is my total drawings in brackets. Now we can calculate the balance at the end. Beginning plus plus minus equals. And that's the figure that will appear in your statement of financial position. Note number 8, trade and other payables. Before we continue with this note, reminder, your step number 1, you don't just focus like me now on each question step by step. Your step number 1 is you take the list of balances and you take it where it's supposed to go. Then you work with the adjustments and you make all the necessary adjustments where you need to do it. And then lastly, you close the brackets, you calculate, and you find the final figures and amounts or amounts. I'm focusing now on each question at a time. Now we're looking at trade and other payables. So what forms part of trade and other payables? You need to look at the list of balances. The first one is creditors control. And you write it in brackets because you don't know if there's an adjustment and we need to change that. Now, adjustment number 3. The details of an employee who was employed on the 1st of July 2023, which is in the beginning of this month, by the end of the counting period, were omitted from the salaries journal for July. The following details are applicable. So take note how salaries and wages can be asked as the year-end adjustment. You need to realize the following. The gross will always appear as an expense in the statement of comprehensive income. All deductions plus the contributions towards those pension fund, medical aid fund, UIF, whatever the case may be, that will go to the fund account and that money is owed to them. It's a liability. Then we need to calculate our net salary. The net salary is the amount which is paid to the employee, and they said no payment was made in this regard. It means that money is still owed to our employee, and if it's still owed, it goes to your trade and other payables. So starting with the gross. The gross was 36,000. That is an expense. It will go to your statement of comprehensive income. Deductions. They have deducted SARS pay as you earn, 7,200. That money is owed to SARS. Then UIF, 1% is deducted, which means that we need to take the salaries, 36,000 times 1%. That will be deducted from the employee's salary. Every debit, there's a credit. Pension fund. Before we continue with the pension fund, UIF is deducted, but the business also contributes towards the UIF, which is an expense to the business. It means that UIF contributions will be debited, but account credited the UIF. That money is owed to the UIF, the Unemployment Insurance Fund. So when you take it to your trade and other payables, and this is what we tend to forget, it's the deduction plus the contribution made by the business towards that UIF. The same is applicable with regards to the pension fund. 8% is deducted and 10% is contributed. That 10% is an expense to the business, which means that will appear in your statement of comprehensive income, 3,600. But the 8%, 36,000 times 8%, is deducted. It's what your employee pays towards the pension fund. Whatever we deduct is owed to that fund account. So when we calculate this, the total pension fund owed will be the deduction plus the contribution. We tend to forget the contribution. Now we can calculate how much we owe our employee. Gross minus deductions equals the net salary, which means that 25,560 is owed to my employee. Make sure that you show all your calculations in brackets. If your final answer is correct, you get full marks. But if you've got something wrong, you're going to lose marks. So don't chuck away unnecessary marks, easy marks to get. Show your calculations. Right, now the next adjustment applicable to trade and other payables. And you will see it will go somewhere else as well. But let's read. And issued a credit note to a dissatisfied customer who returned a device. The selling price was originally $12,800, but 10% trade discount has been granted to her. The business uses a markup of 100% on cost. Issued a debit note to RM suppliers as the defective device was immediately returned to the supplier. So there is two things that's happening here. One, issued a credit note to a dissatisfied customer means that we sold goods and they've returned those items. It was a credit customer, which means that debtors control is involved to show the selling price, to show the cost, trading stock, and cost of sales. But now, the second thing that is happening here, that stock was returned by the customer. We decided to return it immediately to our supplier. And that is the part which is relevant to trade and other payables. So starting with the selling price, or starting with what have they provided me with. They said the selling price was originally $12,800. This means I've sold it less 10% trade discount, which means I sold it for $11,520. If you take 12,800 times 10% and then you subtract that amount from 12,800, you will get exactly the same answer. I just use a shorter way of getting to the same answer. If 12,800 is equal to 100%, minus 10% means that we have sold it at 90%. So that was the value of the goods that we sold. It means that the credit note will reflect this debtor owes us 11,520 less. Debtors' allowances would have been debited. Again, that is not applicable to any of the questions asked here because they didn't ask you to do the statement of comprehensive income. I'm just showing you the T accounts that you have a better understanding. To show the cost. The cost is calculated on the original selling price. Be careful with this, which means 12,800 times 100, because the markup was 100, divided by 200. Means that trading stock will be debited because we got it back. My cost of sales will be credited. This was immediately sent back to our supplier, which means we will owe our supplier less money. It's debited, creditors control, account credited, trading stock. So in your trade and other payables, we are going to say minus 6,400. So when you're doing this adjustment, not only are you going to take this to trade and other payables, but this debtors control, you need to adjust that in trade and other receivables. Trading stock must be adjusted in note number 4, inventories. Right, on 31 July 2023, a customer paid $580 by EFT for installation of a modem. The job has, however, not been completed. The customer has been told that the job will be finished in the first week of the new financial year, which means that we've now received an income in advance. It doesn't form part of my income for this accounting period because the job will only actually be done in the next financial year. Fee income would be debited. Income received in advance will be credited. That goes to trade and other payables. The municipal rates have been paid for 11 months only. 1 month is then still outstanding. That is the easy part to identify. If it's still outstanding, this is accrued expense and must be added. The total amount paid was 24,108. The municipal rates had increased by 8% from the 1st of January 2023. This is now the difficult part because I can't just take that 24,108 and divide it by 11 due to the municipal rates that had increased with 8% from the 1st of January. And if 1 month is still outstanding, it means that July is still outstanding. So from January until 30 June is 6 months, and from August until the 1st of January is 5 months. So to find out what was the amount after the increase, we are going to say 5 times 100 equals 500, 6 times 108 because it increased by 8% equals 648. So what am I looking for now? I want, what was it after the increase? That's why I'm going to take 24,108 times 108 divided by 1,148. That will give me the answer that I'm looking for. What was it after the increase? Another option that you've got is using X. Using X gives you the figure before the increase. Then I still need to work out after the increase. So it says there now, or how to calculate it, 5x plus 6x times 108 divided by 100. To get x alone, you are going to take 24,108 divided by 11,48, and that means 2,100 before the increase. Then I still need to say times 108, 100 plus 8% after the increase, 2,268. So we get exactly the same answer. And this means that the rates will be debited, which is an expense. Accrued expense is going to be credited. This forms part of your trade and other payables. Right, now the next adjustment. The loan from ABA Bank at 15% per annum was taken out on the 1st of May 2023. An annual payment of 38,000 will be made towards the loan in the next financial year. Interest is capitalized every 3 months but has not yet been recorded. So if interest is capitalized, it means it's added to the loan account. So there's 2 things happening here. One, we need to first add the interest to the loan account. The second thing, 36,000 is paid towards the loan in the next financial year. That means that needs to be taken out of your non-current and taken to your current liabilities as current portion of short-term loan. So you've got 2 options here. That 36,000 can either appear on the face of the balance sheet under current liabilities, or it can form part of trade and other payables. I'm going to show you both ways. So if we first look at what is happening with this adjustment, this loan was only taken out on the 1st of May 2023. Our accounting period starts the 1st of August 2022. It means that 200,000 we're going to say for 3 months at 15% means that the interest that is still outstanding, or the interest that we paid, will be 7,500. Interest is capitalized, which means it will be added to the loan account. That balance, 207,500, is now after the interest has been added. But now, they said to you, 36,000 will be paid in the next financial year. It means that will go to your current liabilities as short-term loan. And that 171,500 is the amount which will form part of your non-current liabilities. So if you do, I'm just writing it in a different color so that you can see the differences. If you do show it as part of your current portion of loan in trade and other payables, it means that your total will be 407,000, and that will be the amount that will appear on your balance sheet. This will be then including the current portion of loan. So this is if they ask it, or if you take it to your current liabilities as part of trade and other payables, which is note number 8 in the sole trader. Completing now the phase of the balance sheet, or the balance sheet, statement of financial position. I said we start with the list of balances and you write it in brackets. Now we need to look at the adjustment which we haven't done yet. Stationery costing 780, ordered for the next financial year was paid for and recorded during July. This is a prepaid expense, which means that stationery doesn't form part of my expense for this accounting period. That must be taken out and taken to prepaid expense, which is added to trade and other receivables. Know your formats. If you don't know your formats, you're not going to know where to take it, and then you're going to end up losing marks unnecessarily. Received 2,700 from a debtor who was declared insolvent. His estate paid a dividend of 60 cents in the rand. This was properly recorded and banked. The rest must be written off as bad debts. This means, be careful. We've already received 2,700 and it was recorded. What we have not yet recorded was the bad debts, which should be written off. Now don't take 2,700 and say times 60 divided by 100. Then you're going to get it completely wrong. That 2,700 is equivalent to the 60 cents which was paid. 40 out of the 60 must then be written off, so 1,800. Debtors control will be credited, bad debts will be debited, so we need to minus 1,800. According to the physical stock count on 31 July 2023, the trading stock shows a surplus of 8,900. This time, they provided you with the surplus in this case, or it could have been a deficit. If it's a surplus, it means that it should be added to the trading stock account, 8,900, because trading stock surplus is an income. Then a cash customer complained about repairs done. He was given a cash refund of 90 Rand, but from the petty cash, and this has not been recorded. Means that fee income will be debited and petty cash will be credited, which means minus 90 in your cash and cash equivalents, because petty cash forms part of cash and cash equivalents. Then we had that adjustment. I'm not going to explain it again, but the adjustment with regards to the customer who returned the device, and then we've immediately sent it to our supplier. So what you needed to do with debtors control. Debtors control is going to be credited with the amount after the trade discount, so minus 11,520. Trading stock, it actually cancels out, but show your calculations. It is plus 6,400 because we got it back from the customer, but we immediately send it back to our supplier, so minus 6,400. Now we've done all the adjustments, so we can fill in the rest of it, which means from note number 3, the carrying value at the end of the accounting period. Close the brackets, total inventories, trade and other receivables, cash and cash equivalents. Yes, make sure there isn't a lot of space here, but make sure that you add and subtract the correct figures in that line. Don't make a mistake with that. Once we've calculated note number 4, 5, and 6, we can add it together to find out our current assets. Note number 7, the balance at the end of the year goes to your capital. And then we had note number 8. So again with note number 8, if you choose to show current portion of loan as part of trade and other payables, it means that 407,000 will appear as part of trade and other payables, and that will be your current liabilities. Or you can do the following. 200,000 was the mortgage loan. 7,500 should be added, the interest on loan. Whatever we pay in the next financial year must be subtracted from your long-term liabilities and taken to your current liabilities as current portion of loan, 36,000. Can you see? I'm not showing it as part of note number 8. I'm showing it on the face of the balance sheet. Now we can calculate our total non-current liabilities, which is the same figure as in here, which means that my trade and other payables, if we total that, is 371,000. And if I take 371,000 plus 36,000, it equals 407,000, which was the same as before if you would have shown that as part of trade and other payables, the current portion of loan. So we mark accordingly. It either goes as part of note number 8 or it appears on the face of the balance sheet. If they don't ask you to do any notes, then it must appear as part of the calculations here, face on the balance sheet, current portion of loan. Rather show it. Actually, you can include it in trade and other payables as a calculation as well. So it's irrelevant. Please ignore that. Moving on. What can we calculate next? Remember that the fixed assets, the fixed deposit was a missing figure. It means that we first need to solve equity and liabilities. We can solve that. Your total capital plus non-current liabilities plus current liabilities equals total equity and liabilities. You should know that this should be the same as your total assets. Now we work backwards. Minus current assets equals non-current assets. So your fixed deposit becomes the balancing figure, 250,000. Now we've completed that. Question 4.2.3, the owner asks you to write a report on the following questions. So the first question, is the business liquid? Would we be able to cover our short-term debt without being forced to sell our stock at a lower price? So these are the type of questions that we need answers to. And when we're looking at those questions, we're looking at the current ratio and the asset-test ratio. To calculate the current ratio, take your current assets divided by your current liabilities. That means 2,3 to 1. It's always to 1. It must be expressed in a ratio. Asset-test ratio is two options. You can either take current assets minus inventories, or you can add note number 5 plus note number 6. Again, it will depend on how the information is given to you in a test or in an exam. This means that my asset-test ratio, your current assets minus inventories divided by current liabilities, equals 1,1 to 1. So when we need to comment on that, when we comment, we compare last year's figures with this year. We don't have last year's figures, so we cannot compare it to last year. Then we can look at these two, and I always refer to them as the BFFs. They are best friends forever. We can look at, is the business liquid? Does our current assets exceed our current liabilities? Yes, it does. And if we take inventories out of the equation, because inventories, we might have too much money tied up there, we're not able to sell it as fast enough, quickly turn it into cash. Would we still be able to meet our short-term obligations? And the answer is yes, because that is more than one. It exceeds the current liabilities. So to answer this now, do it in bullet form. Keep it short. Is the business liquid? That's what we need to answer. Yes, the business is liquid. Why? The current assets exceeds the current liabilities. Every R1 owing that current liabilities of short term, the business has R2.50. Should the R1 be paid off, the business would still have R1.50 available. R2.50 minus 1 equals R1.50. The same as with the assets ratio. Even if we're not able to sell our trading stock under abnormal circumstances, we would still be able to meet our short-term obligations. So yes, the business is liquid. Remember, before I continue, this ratio could be too high. There could be that your trade and other payables, your cash and cash equivalents is too high. Because we can generate more profits. Think about it. If your bank account, we can rather invest that money, and what will be the return on that? It will be interest on a fixed deposit instead of it just lying there in our current bank account, which is little interest that we will get. Right, is the business solvent? So when we're looking at these questions, we're looking at the solvency ratio. Does our total assets exceed our total liabilities? That means we need to take total assets. Total liabilities means non-current plus current. So you need to add that together. So take total assets divided by total liabilities. Is the business solvent? Yes, because the total assets exceeds the total liabilities by R4.60 or 4.6. For every R1 owing, the business has R4.60 available. And should the business pay off its debts, there's actually a surplus of R3.60. 460 minus 1 equals R3.60. Then, what was my return on my investment? Is it still in line with alternative investments? To find that out, you need to use the return on average owner's equity. So, I don't know what's the average equity by looking at this, because average means beginning plus end. And I don't know what's the net profit by looking at the face of the balance sheet. So where do I go to solve this? We can look at note number 7, capital. The net profit divided by your average owner's equity means the beginning plus end divided by 2. So my percentage return is 34.8%. Compared to alternative investments, this is a good return. Because if you looked at the list of balances which was given, the fixed deposit, the business is earning 9%, and 34.8% is even much better than that. So this is a good return on the investment if we compare it to alternative investment. Again, we don't have last year's figures, so we can't compare this to last year to see if there's been an improvement or not. The next step, compare to alternative investments. Thank you very much. I want to leave you with this quote. An investment in knowledge pays the best interest. We're going to look next at activity 5, which will only focusing on the analysis and interpretation. But now we're going to look at analysis and interpretation where it's given to you and you need to use that to find figures. Hope you have a wonderful day.